Opendoor stock continues to be one of the most closely watched tickers in the market right now, and as we head into Friday's pre-market session, the question on everyone's mind is simple. Is a bounce on the table, or will the stock remain in consolidation mode after the post-earnings volatility we've seen this week? Let's start by setting the scene. On Wednesday, Opendoor shares fell sharply, closing the regular session down about 25% to $1.87 following its Q2 earnings release. That drop was driven less by the actual numbers, because on paper, the results were strong, and more by management's softer guidance for the second half of the year. They noted that persistently high interest rates are limiting their ability to acquire new inventory, which naturally affects revenue expectations. On Thursday, the stock saw a late rally during the session but still closed modestly down by 2 cents at $1.85 per share. In the aftermarket, it held steady around that level, showing no signs of another big swing either way. This sets us up for an interesting pre-market Friday scenario. We've seen the sell-off, we've seen some stabilization, and now the market is deciding whether the next move is higher, lower, or sideways. Now, while it's tempting to point to past rallies as evidence of what might happen next, remember, this is the same stock that surged over 36% in a single Friday session recently. This time we have to acknowledge that conditions are slightly different. Back then, sentiment was building into earnings and short interest was high, with momentum traders piling in. Right now, we're in the immediate aftermath of an earnings event, where the market is still digesting not just the headline results but also the guidance and the macro backdrop. That said, there are still reasons to believe that a bounce, perhaps not of the same magnitude, but a meaningful one, is possible. Let's break them down. First, the fundamentals from Q2 were strong. Opendoor sold 4,299 homes, generating $1.6 billion in revenue, which was up 5% from the previous quarter. Gross profit came in at $128 million for an 8.2% margin, and contribution profit was $69 million with a 4.4% margin. Most importantly, the company posted its first quarter of positive adjusted EBITDA in 3 years, $23 million, and narrowed its adjusted net loss to just $9 million. These are clear signs that the business model is proving resilient, even in a high-rate environment. Second, the macro environment may soon shift in Opendoor's favor. The weak job data coming out this week has increased market expectations that the Federal Reserve could cut rates as early as September. Bond markets are starting to price this in, and if that cut happens, mortgage rates could ease, housing demand could pick up, and companies like Opendoor could see immediate benefits. This would naturally feed back into their Q3 and Q4 performance, potentially beating the current cautious forecasts. Third, the activist and retail investor narrative around Opendoor remains strong. Eric Jackson, a well-known investor, has been vocal about the company's potential, appearing on Bloomberg Radio to discuss his views. He's still upbeat on the business's long-term prospects, even while suggesting that a leadership change could be worth considering. On Thursday, he also shared an open letter from long-term retail shareholders that called out management for a lack of urgency, transparency, and insider buying. The letter didn't mince words, but it also reaffirmed belief in Opendoor's technology, market potential, and brand recognition. For many retail investors, this letter is both a call to action and a sign that there's still conviction in the name. Now, in terms of scenarios heading into Friday's trade, I see 3 main possibilities. Scenario 1. We get a modest pre-market bid that extends into the regular session. Retail traders, momentum players, and even some value investors see the combination of strong Q2 results and macro tailwinds as a reason to re-enter. If that happens, short interest could provide additional fuel for a rally, even if it's not a full-blown short squeeze. Scenario 2. The stock trades flat or slightly down as the market continues to digest the earnings narrative. This wouldn't necessarily be bearish, it could simply be consolidation after a volatile week. Sometimes a period of sideways movement is healthy, allowing for a stronger base before the next move higher. Scenario 3. Selling pressure resumes, either because the broader market turns risk off or because traders focus solely on the softer H2 guidance. In this case, the stock could drift lower in the short term. But for investors with a medium to long-term view, such dips may present opportunities to build positions at more favorable prices, especially if they believe rate cuts and a housing market rebound are on the horizon. It's also worth noting the seasonality factor in real estate. Management's softer revenue forecast for the back half of the year isn't just about interest rates, it's also about the natural slowdown in home sales in Q4. This is a seasonal pattern the market tends to forget, but it's a reminder that not all weakness is structural. If you strip away the seasonality and look at the core operations, the progress is real. From my perspective, and this is not financial advice, I think the medium-term setup for Opendoor remains attractive. The stock has already priced in a lot of bad news, the fundamentals are improving, and there's a clear macro catalyst in play with the Fed potentially cutting rates. That said, I also think it's important to remain realistic. Friday could be choppy, and there's no guarantee of a bounce. If it comes, it might be gradual rather than explosive. What makes Opendoor so interesting right now is that it's at the intersection of multiple narratives. A recovery story based on operational improvements and profitability progress. A macro-sensitive trade tied to interest rate expectations and housing market health. An activist-driven story with retail investors and prominent voices pushing for change and accountability. If these narratives converge, say we get improving macro data, management responds to shareholder concerns, and the business keeps delivering on profitability, then the upside over the next 6 to 12 months could be significant. For now, Friday's pre-market will be the first test of whether the market is ready to pivot back to the bullish side after this week's shakeout. Even if it doesn't happen immediately, the pieces are in place for a potential turnaround. It's just a matter of when sentiment shifts from caution back to optimism. As always, I'll be watching the open closely to see if there's an influx of buy orders or if the market decides to wait for more data. If you're following this story, keep an eye on pre-market volume and any fresh headlines, particularly around interest rates or housing data. Those could tip the scales one way or the other. Opendoor is not a stock for the faint of heart, but for those willing to navigate the volatility, it remains one of the most compelling medium-term stories in the market right now.